Hey, this is Corey Bulldroff, the real estate guy, bringing you this edition of the monthly market update here in February. We're going to be talking about home ownership to hedge against inflation, rising mortgage rates, and also the forbearances. And ultimately, are we coming into another real estate bubble or crash? So with no further ado, let's get into it. So to start off, we're going to be talking about homeownership as a hedge against inflation. Most of us, our monthly payment of our mortgage is our biggest monthly cost. So to have a fixed monthly cost is a great way to hedge against inflation. From Investorpedia, real estate is one of the time-honored inflation hedges. It is a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. To show you this great chart, here is going back all the way to the 1970s, taking home ownership as a hedge against inflation. So this is home price appreciation versus consumer price increases over the decade. And you will see going back to the 1970s, where it was 7.1% average inflation, we have a 9.9% average home appreciation. Into the 1980s, the 90s, up until the 2000s, you were basically able to hedge home prices against inflation. Now, during the 2000s, we came into the 2007 crash. It was definitely not a normal market, not a normal decade, and we fell just slightly under the inflation of home price appreciation. Back to 2010, that's where we really start to see that gain and that hedge of being a risk reward situation, all the way to 2021, where we saw a very, very high inflation of 6.8%, but that was muted by the 18% appreciation in home prices. So as you can see, this is a great way to hedge against inflation. We look at a fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same, and that's definitely not the case if you're renting. So as we look at this chart, this goes back to 1970s, and you're going to see that at the very least, inflation and rental prices are at the same, but more than, you actually have a higher rental appreciation than inflation, making it even harder to afford those dollars. According to Forbes, homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. So the next thing we're going to look at is the Home Price Expectation Survey. Now this survey, they take a survey of 100 of the chief economists in our country, and they kind of ask them the question, where do we see a cumulative house appreciation going in the next 5 years? So when we look at the orange, those are the pessimists, those are the ones that believe it's going to be the worst. We still see a 23.7 cumulative appreciation in home prices. So if you buy your house for $100,000 today, the worst that the chief economists are seeing is $123,000. So a $23,000 net gain every $100,000 your house is worth. Now the average panelist, about the average, they see about a 43.3% cumulative appreciation, all the way up to the optimist of 62.5%. So you can see that buying today, according to the chief economists, no one has the crystal ball, but you are going to be sitting in a very healthy situation of home ownership, equity, and appreciation over the next 5 years. So I hope all this is helpful to see that home ownership still is a very great way to hedge against inflation, as well as a great way to build wealth. Now, the next thing that we said we were going to talk about is mortgage rates and how they're on the rise. So mortgage rates remain unchanged from last week. This was taken February 3rd of 2022. This is a Freddie Mac chief economist. The economy lost some momentum in January, leaving mortgage rates unchanged from last week and relatively flat for the third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19. which we believe will subside in the coming months. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains low, driving home prices higher. So we look at the average 30-year fixed right now is roughly around 3.55%. I think it ended in the low threes at the end of last year. So, but when we look at back to 2020, going right before the COVID lockdowns and shutdowns, we were right about 3.7%, and we were on the trajectory of heading down. Then COVID hit, and to counteract what was going on, rates kept going lower and lower, and ultimately to a 40-year low of just under 2.75. And now we've slowly creeped ourselves back up to 3.55, but still lower than we were pre-pandemic. Going back to 2018, we can see rates were about 4%, and they went all the way up to about 5%, and then they started the trajectory down. But you can see over the last even 4 years, 3 years, 3.55% is still a great interest rate. And if we go back to 40 years, you're gonna see it's a great interest rate. So I know it's rising, but do know that it's still a great interest rate to have on a 30-year fixed, historically speaking. According to the chief economist of Freddie Mac, as mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. In 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. So remember, we have two different markets. We have the refinance market and the home purchasing market. Now, when you're refinancing, obviously you're going to refinance to ultimately get you a lower rate. Sometimes people refinance to get cash out, either because they necessity, or they want to put it into their home, they want to make a big purchase, or as myself, I take out every penny I possibly can, put it into the bank so that I can have that money to invest with when the right opportunity comes up. Ultimately, when we went down, we kept decreasing, people kept refinancing because it takes about 0.5% in interest rates to lower or to make sense for someone to do so and to be able to save and recoup that money. When we look back to the 1970s, so the last 5 decades of the average interest rates on a 30-year fix, in the 1970s, we had 8.86. In the 1980s, we went all the way up to 12.7. I think we, at one point in time in the 80s, we actually had a 17% interest rate. Then we started coming down to the 90s, 2000s, and to 2010. And even in 2010, the average rate was 4%. So we're still on a 50-year low at 3.55%. So if you are looking to buy, this is still a great time, historically speaking. When we look at interest rates, the one thing that we definitely want to keep an eye on is the 10-year Treasury. Now, although it does not control interest rates, it definitely has shown that it mirrors or has an influence on mortgage rates. So in 2021, we saw it 1.43, and then it has risen over the last year to 2 years to 1.81%. So it's only, natural for the mortgage rates to rise due to this influence of the 10-year Treasury. When we look at the 10-year Treasury over the last 50 years and how it's connected to the mortgage rates, you will almost see an identical trajectory and system going on with mortgage rates compared to Treasury. Now, they're not the exact same, obviously, because the big banks definitely have to make some money on that 10-year Treasury, but it is based on those facts. Some reason I think it is because most people will refinance every 3 to 5, if not every 7 years. So the mortgage bankers know that if they're taking notes out based on the 10-year Treasury, they can know that that's going to be pretty similar to how long someone's going to keep their mortgage rate before refinancing. So mortgage rates hit their highest levels in since March 2020, leading to the slowest pace of refinance activity over the last 2 years. So again, You're going to start hearing a lot of things on, on the news and different news articles saying that, refinances are all-time low. Is the market coming to a crash? No, it's just that the rates aren't what they were the last 2 years, and pretty much everyone who had an opportunity to refinance took advantage of those low rates. And if you have a 2.7 or a 3% interest rate, why would you refinance? A lot of times you'll take out a home equity line of credit if you need the cash, or maybe a second if you need the cash. Very rarely would it make sense to refinance, take cash, and restart over your loan period. So the last thing I want to talk about is forbearance, the foreclosure market. Kind of like you're going to see on the news, there's a scare, foreclosures are coming, the real estate crash is coming, the bubble's going to burst. So I wanted to show you real stats and facts so that way you can make an educated decision. I know we've shown this chart before. Going back to May of 2020, right when the pandemic started, we had 4.7 million people that elected to go into forbearance. Basically, they couldn't afford their payments or didn't want to afford their payments or got the option to put their payments on the back end. So they went in some type of forbearance. What we've seen over the last 2 years is that people have slowly made it out, not even slowly. So what we've seen over the last 2 years is those 4.76 million people that are in forbearance, they started making payments. They started making plans. They went to the bank and said, how can we solve this? How can we get out of this period? All the way to January of 2022, we saw there's only 780,000 people in forbearance at this time. Now, even one person is, not a good thing. I don't wish this upon anyone, but we really need to understand that all these foreclosures that were supposedly coming are probably not going to come. When we look at the Black Knight data, Andy Walden, as the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. Ultimately, they've made it a deal with the bank or they've gotten out of that forbearance program. So when we look at the chart, we look at 19.5% have made monthly payments during their forbearance payment. We look at 6.9% have paid off their loans. So they sold, refinanced, or paid off what they owed. 11.7% have brought their past due payments up to current and are currently paying their mortgage on time. We're going to see about 43.7% have worked out plans of the repayment. And there's about 18.2 that are still in trouble. 1.3 have actually started the forbearance or the foreclosure process. And about 16.9 have just not made either an attempt with their bank, haven't contacted the bank, or still trying to figure it out. What we do know is that 90% of the people that are in forbearance have at least 10% of equity. So even the ones that still haven't made an arrangement with the bank or a payment with the bank, more than likely can put their houses on the market, and if nothing else, pay off all the fees, pay off their loan mortgage, and hopefully walk away with some money to be able to move forward in their life. When we look at foreclosures actually in a normal market, so when we went back to 2017, which we were in an appreciating market, so not many reasons to be in foreclosure, we had 314,000 in foreclosure. And in those 3 years, 2017, 18, and 19, we had about 290,000 in the foreclosure process. Now in 2020, during the forbearance, and 2021, we saw those numbers come down extremely down to a minimal of 29,000 who actually went through the foreclosure process in 2021. That shows you that the forbearance program definitely worked, and I think it's something that the government should make sure is available to people even after COVID. But you're going to see that even if all the people went into foreclosure, we're still a very small number compared to what the average is. When we go back to 2005, on an average, we see anywhere from 700 to 1.2 million people go into foreclosure in any given year. And that's going back the last 40 years. Either people lose their jobs, they get sick, they're mismanage their money. There's always different reasons why people are going to foreclosure. Now, during the crash of 2007 to 2015, we had 1.3 at a high of 2.9 in any given year going into foreclosure. Over almost 9 million people went into foreclosure in that 8-year period. Coming to 2016, 17, 18, 19, we saw a steady decline going into foreclosure, and a lot of it had to do with appreciating market. When we're in an appreciating market, there's very few reasons why you'd go into foreclosure rather than just putting your house on the market and selling it. We have seen a little bit of a hindrance due to rising rental prices. So it used to, in 2007, you could let yourself get foreclosed on knowing that your payment would go from a $3,000 mortgage to an $1,800 rent. Today, you're going to go from a $3,000 mortgage to maybe a $3,600 rent. So you're not going to want to just allow yourself to go into foreclosure. So you can see that we're at a very, very small number of foreclosures. And even if all 780,000 people decided just to not care about their 10% of at least in equity and decide just to let themselves go into foreclosure, we are nowhere near the 2007 bubble crashing market that we're into. And realistically, we're at a very shortage of an inventory, because during the 2007 to 2015, there's a lot of houses on the market, not just ones that were in foreclosure, but ones that were selling with equity. Now we're seeing very few houses on the market. So if you do see one go on the market, whether it's in foreclosure or not, it's selling at top dollar and sometimes getting into overbids. So we may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick though. From an extraordinarily low level, we're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. So this kind of shows you we're not coming into a real estate bubble or a crash. We're actually going to see home prices more than likely appreciate over the next 5 years. We're going to see mortgage rates increase over the next 5 years. So right now, if you're not a homeowner, I suggest do whatever you can to make yourself eligible or qualified to buy a home this year. This is the year to do it. This is the year to help you start building wealth through real estate. If you guys ever want a current market analysis on your home, see how we can help you get qualified, even if it's your credit, I can see how I can help your credit, just reach out to me. I'm always here to help, never to pressure. And as always, if you ever know of anyone looking to buy, sell, or invest into real estate, please know you have a great realtor that would love your referrals and will treat them and give them 5-star service. Until next time, Corey Boldroff, the Real Estate Guy.